So, hi everyone, we are back for another portfolio roasting episode here, episode number 2. Andrew, we have the goal to keep this episode under 1 hour. We'll slowly improve and try to keep the episode shorter and shorter, see how short we can keep them. But at the same time, we discussed beforehand, we also enjoy talking stocks, right? So we don't want to artificially limit us to, say, 20 minutes or so. We'll just really talk and see where it leads us. Before we start, I wanted to basically promote that we are interested in looking at a ton of different portfolios over time. We have one more in the backlog right now. And if you want to get your portfolio reviewed, I guess that would be the kind way to express it or roast it. That would be to go with the brand name. Just send us an email. I've actually created a new email address to streamline the whole application process. And I'll walk you through the next steps. Then I hope people will reach out, Andrew. I hope we don't run out of portfolios to review. But I think there should be demand for it, right? If you have any encouraging words, go for it.
Sorry, my dryer just went off. Okay, that's done.
No worries. Anything you can say to encourage people to hand in their portfolios?
No, I mean, I think it's especially, Renee and I, we constantly go back and forth talking about our stock portfolios with each other. We have a couple other mutual friends who are, well versed in investing, and we bounce ideas off of as well. And I can say I've learned a lot from just getting, Renee's opinion, several other friends' opinions. So maybe you're someone who doesn't, maybe share friends with a similar interest as you, and you want to bounce your ideas off of someone else. I think it's, very helpful. And maybe you do have people that you share ideas with, but maybe you just want more thoughts from other people, different perspectives. Take what we say with a grain of salt. Take what we say. Maybe you can learn some things from what we say, and other things you might disagree with. But I don't think it hurts to have your portfolio. More eyes on your portfolio and different opinions. Certainly can't hurt, right? So yeah, if you want to join the video, send it in.
If anything, I would like to get my portfolio roasted. I think there's very little to gain for me if I give my portfolio or show it to someone and just sort of fish for compliments. I want to hear what people could potentially criticize about, well, the stocks I own, the current valuations, and so on and so forth.
Yeah, it's also a good way to get to know really how well you know your companies, because a lot of times, when Renee and I do this, I'll bounce off an idea to him, and I'll say, be the devil's advocate, pick this apart for me. And really, it's like a test to see how well you know it, because a lot of times he'll point out, with very basic research or whatever, he'll point out, the questions he has or the concerns he has. And I should, if I've done my job properly, I should have the answers to those concerns. And it's a good way. And a lot of times if he asks me questions and I realize, more and more I don't have the answers, and that actually, that does kind of make sense, then maybe I didn't do enough research and I should probably go back to the drawing board. So
yes. Or you are somebody to kind of transition to the person we are going to look at today, like Lorenzo, who only started investing quite recently. He only started in 2024, which we'll get to in just a second. And as someone relatively new to this discipline, I guess there's a lot to gain for you as well, just to get the opinion of people who've been doing this for a little bit longer. So let me introduce Lorenzo real quick. So Lorenzo is 38 years old. He lives in Barcelona, Spain. Definitely a beautiful city. I think you've never been to Europe, right? So if you ever go to Europe, I think Barcelona should be on your bucket list. He works as a beverage director for Hospitality Group. And his fun fact that he shared with us is that he loves pina colada, which is great. He shared his combined income together with his, I'm not sure if he's already married, let's just say his partner. And they have a combined income of 75,000 euros a year, which translates to a monthly income of 6,250 euros, which is great, of course. Off of that income, they contribute around 1,200 euros to 1,500 euros into their portfolio. I guess it's a shared portfolio. And that translates into a savings rate of 16 to 20%. Before I ask you about your opinion, Andrew, here, a few thoughts from myself here. So first of all, I think that they definitely have a very solid income, at least by European standards. So I would say that's definitely an above average income for a couple. And their savings rate looks great too on the surface. However, I was drawing this arrow here, right? Because he also shared that he actually doesn't have to pay rent, because apparently he owns another apartment and he uses the rent he receives as the owner of that apartment to pay his own rent. And considering this, I actually feel like he could have a higher savings rate. So I don't think it's particularly impressive considering that one of people's largest expense, which is to pay rent or to pay a mortgage, like in your case, Andrew, is not an expense for him, right? So I feel like, and obviously we encourage the people who hand in their portfolio to share the details in the comments down below, but I feel like maybe they could do even better here in terms of their savings rate.
Yeah, he certainly could, but I think maybe if we take a wider lens, right? So if we break this down, kind of like how you would look at a company, his it's essentially a 16 to 20% free cash flow margin, right? But we mark that as a savings rate. However, that's really just what's being contributed to the investment portfolio. So really, that's just a reinvestment rate. Whereas, I don't know, maybe he does take some more of that money and puts it into a savings account, because if he is managing a property and anything goes wrong with that, whatever, yeah, and he also has children, right?
Mm-hmm.
You and I don't have children. Maybe he's just of the mindset where he prefers to have a far greater cash cushion than he would ever really need. And I can't blame him for that. The 16 to 20% investment rate, honestly, quite frankly, is even higher than mine. So and that's not even including, like I said, perhaps his savings or anything like that. So
yeah,
I
that's
honestly,
actually a very good point.
yeah,
It's only the contributions to the stock portfolio or investing portfolio.
Yeah, no, I actually think it's really good, especially like I said, with his kids and everything. He could just be playing it extremely conservatively, and I don't get on anyone's case for being too conservative over their finances.
And I don't want to be overly critical here. If you have a savings rate of say 10% plus, and you're relatively young like he is, and you plan to do this for the next 20 or 30 years, chances are you will have a very favorable outcome after 30 years. So I just was trying to give him some food for thought, maybe if there is room to improve it a little bit.
Which there very well might be, you know. Maybe that's something he wants to look at.
Yeah, I want to encourage him to comment down below. In terms of his investing background, so I already said he only started earlier this year, so in February 2024. Then I asked a couple of questions about, well, first of all, how he felt when he started. And he said he felt seduced by the stock market, and I guess overwhelmed also by the complexities, which is probably a quite common experience for people starting out. I think the world of stocks, when you're completely new, feels very overwhelming with all of the terminology, all the different ways you can invest. I remember you shared a voice message with me the other day in which you laid out the different investing styles that you have tried out over a relatively short period of time, and finding your style and what actually works long term is, I think, something that people struggle with early on. But let's not spend too much time discussing this. Then I asked him about his biggest investing success, which was a 40% gain on Nvidia stock, which I could comment on right now, but I'll comment on that a little later. And his biggest investing mistake was that he early on bought 2 biotech companies, and he never felt comfortable in owning these. It felt more like gambling to them, apparently, which I guess you can tie to the Nvidia investment as well. So my impression here is, if you're relatively new to the world of stocks, there's probably no way you fully understand Nvidia's business model. And I guess understanding the business model of 2 biotech companies, if you don't have a background in these fields yourself, will be even harder. So I can totally relate to him feeling this like gambling.
Mm-hmm. Yeah, my hunch actually is that both his biggest investment success and the mistakes are all gambles, and just one worked out and one did not. So
yeah. The portfolio size right now is 70,000 euros. We'll get it. That's actually a little bigger I think I might have forgotten to update that exact figure. It's actually a little bigger once you take into account that he owns some bonds as well. So I'll share the exact figure or the exact portfolio size in a second. His goal is that he would like to leave a nice portfolio of assets to his daughters. And when he retires, he would like to receive some sort of stable stream of dividends, which makes a lot of sense. And obviously, he would like to pass that constant stream of income on to his daughter. I'm not sure if he has one daughter or two daughters here, to his children too, which again is a reasonable goal to pursue, I guess. Anything to say here, Andrew?
I agree. Yes.
Yeah. Before we take a look at his actual portfolio, we have to put a big disclaimer here. Just like in our first video in which we roasted someone's portfolio, we want to make very clear that we are, of course, not financial advisors. We are just recording this video for educational purposes, and everything we share here is just our opinion. In fact, we might own some of the stocks that will be discussed. Feel free, Andrew, whenever we forget maybe to disclose it, remind me, oh, I actually do own stock X, Y, or Z myself. Yeah, and we always recommend that you consult with a financial advisor before you make any significant investing decisions. And what I also want to bring up in every single video, actually, Andrew, so people know how to kind of classify our comments here. We both are investors who definitely pursue a value investing philosophy. So we definitely approach stocks with a business owner mindset. We acknowledge that stocks or businesses, in fact, have a so-called intrinsic value, and that the price these businesses are trading at on public stock exchanges may differ materially from that intrinsic value. And whenever that happens, this may represent an opportunity to us by either acquiring a stake in that business or maybe disposing a stake if the gap becomes, if the price the company is trading at is significantly exceeding the intrinsic value of that company. But of course, there are different investment philosophies that may also, lead to successful outcomes. But we believe, and I think we expressed this in the last video, that a long-term focused quality approach is suitable to for a lot of retail investors, just because it requires less time than, say, some sort of trading approach. Which brings us to Lorenzo's investing strategy. So I asked him, well, how would you describe your own investing philosophy? And he said, basically, most of my money is invested in Spanish bonds, which we will get to soon, which mature on February 6th, 2025. And then the rest of my money is in funds and in individual stocks. As for stocks, I look for stable companies that I'm pretty sure will be around for the next 15 to 20 years. So this is pretty much aligned with our philosophy here, right? So having a very long-term mindset. And these stocks need to pay some low dividends, have less than 1 year of earnings and debt, and have a nice buyback program. I was talking a lot, Andrew, so let me just give you some room to comment on his investing strategy here.
No, I actually don't have much else to add to that, quite frankly.
What I noted down is, and that is something we expressed last week or 2 weeks ago already, it doesn't make sense to artificially limit your investing universe to dividend paying stocks. So I would encourage Lorenzo to consider investing in stocks that don't pay a dividend as well.
And at the same time, that's true. I would probably add that in as well. And also the buyback program. Buybacks are nice. Most of my companies do have a buyback program, but once again, there's no need to focus strictly on a buyback program, especially if a company does have a capital allocation mindset. They're not just going to willy-nilly be buying back their stock if it's, trading at 100 times earnings. So, obviously just kind of think outside the box there. I think it's a good focus to have, but once, as Renee said, you probably shouldn't limit yourself just to that.
Yes. And even the debt criterion, I feel like is a little too strict. So I think both you and I, we really prefer investing in companies that carry very little debt. But 1 year of earnings is hard to find. And you also have to understand that debt itself, as long as it doesn't become too big and the interest payments really eat into your profits, isn't necessarily a problem. So I think for most businesses, carrying some debt might actually be beneficial.
Yes, you and I do actually disagree on this slightly. Not that I disagree. I know that I'm far too conservative just because I've been burned by debt before. But instead of a 1 year of earnings, I prefer cash in the bank versus debt. So just like I run my own personal finances, I'll never take out, other than a mortgage or something, which you could honestly classify as like a lease liability under debt, which I never classify as real debt. But if you understand how to really read a balance sheet and understand debt, real debt, I like to have that number covered by the cash on the books. So same thing with myself. I'll take out loans and stuff, but typically I'm never taking out a bigger loan than I have enough cash sideline to pay that off in case of an emergency. But I am actually really strict on that criteria and far more strict than Renee is. So once again, though, if it all, whatever works for you, but I agree, 1 year of earnings is probably not the best way to go about it. That's definitely going to limit your world of
Investment
comfort. Yeah, exactly. Yep.
Yeah. Which brings us to his questions and maybe some of the worries he has. And as we did last time, so I asked him to send me a voice message. It's quite long. I think I will play everything to you here, Andrew, but I think for the YouTube video, I will maybe cut it a little shorter. I think it's almost 4 minutes in total. So let me just play it to you, okay? You've never heard it before.
Nope.
Hi, Renee. How are you? At the beginning, as I told you by email as well, I feel more like gambling than investing. So basically, some of the inversion I did at the beginning, and I was quite lucky with it, was Nvidia. I bought it in March, and I remember 810 euros, something like this, and I was pretty lucky. And now I feel a bit stupid as well, because I bought like 12,000 euros. We don't know, basically, I knew Nvidia was doing it, but we don't know basically nothing about the money they were doing, nothing about stocks. Basically, my gain on Nvidia was about 30-35%. And that's it. Then I sell it because I thought it was enough luck once. So I just sell it, and I decided to do maybe divide the money in something a bit more clever and for better experience. And basically, I bought 2 biotech. When after a few months, I realized that it was an inversion for me. I mean, it was like guessing and gambling, and so I didn't really feel there was what I was like feeling comfortable with the stocks. And especially when I was in red, likely it wasn't much money I put in them, because I already knew there was a bit like a bit crazy as inversion, so it wasn't much, but I lost like I think 150 euro in one, and 100 euro to 100 in the other one. So yeah, like 300-400 euros. But actually, I realized just like a couple of days ago, then both of these stocks they did really good on the on the studies they did, and the stocks they higher, basically our price I paid it, maybe even higher. So if I held it, I probably now I haven't lost any money, but still, I prefer like this because I feel comfortable to not have it anymore.
So the way I would summarize it, Andrew, is he's basically describing his experience of buying Nvidia and also the 2 biotech stocks we mentioned earlier. And what I'm hearing here is someone who's clearly very new to the world of stocks. I hear a lot of talk about, well, the prices of the stocks, and very little to nothing about the actual businesses and what they do and how they develop fundamentally. So I feel like he understands now that this is not a sustainable strategy. And that's something I feel like I talk a lot about on my channel, that you definitely have to have clear processes. Or actually, someone told me it's processes in place to beat the market over the long term.
Yeah, it's and he admitted to it. He was pretty much just gambling, but I mean, I'd be lying if I said I didn't start very similar as well. It's just all about learning from your mistakes, learning what works, what doesn't work, and then moving forward from there. And really taking the lessons you learn and abiding by them. But yeah, so I mean, he's reached out to you, so clearly he's trying to get on the right path, right?
Yeah. And if we look at the question he handed in written form, because he didn't really articulate a question in the voice memos themselves, but he's worried that he's buying at too high prices, which reminded me of, well, just the broad topic of valuation. You cannot invest if you don't do any valuation work. Otherwise, you are in fact gambling, because my definition of investing is to buy assets at a price where you feel like they are cheaper than the actual intrinsic value. And if you don't do that, and you can only do that if you value companies, well, you're not investing, in my opinion.
Yep. Right there, though, he says talking about valuation and 15 to 20, 10 to 15 years, he may experience no gains. But his goal is really to use the money in 25 to 50 years, or 25 to 30 years. I'm sorry. If you're doing stock selection too, like individual stock picking, I think what's important is maybe learning from something like Phil Fisher, taking a Philip Fisher approach, where he actually sets a specific criteria for himself too. And he says, typically, if a thesis and a stock valuation and the returns that you're expecting to get doesn't work out within 3 years of the time you bought the stock, you should probably just admit that was probably just a mistake. It could have been a value trap, whatever, and then just move on. And he says, and he does say, 1 out of 10 times you do that, you might miss where, as soon as you sell, it does end up taking off. But he goes, 9 out of 10 times, if you buy a company and you haven't had any gains over a 3-year period, and the market hasn't realized what you thought it should realize, you either made a mistake with your valuation or your thesis in general. And from my experience, that's probably relatively accurate as well. So I wouldn't worry about the 10 to 15 years. If you're flat for 10 to 15 years, you probably really messed up on either the analysis or the valuation. So yeah, that's all I want to say.
And you should have probably then acknowledged your mistake sooner.
Yeah, exactly. Yeah.
Perfect. So we're now getting to the, I guess, more interesting part of our analysis here, or our portfolio roasting. So what you can see on screen right now is basically Lorenzo's portfolio in terms of different asset classes. So what you can see is that in total, so as I said, the number I shared earlier was off. In total, his portfolio is worth 133,000 euros, which translates to around 150,000 US dollars. So which is quite significant, actually. No play money. Let me put it this way. And of that 150,000 US dollars, what is it? 68% is actually invested in a 1-year Spanish bond. I think he described this earlier. 18% is invested in all sorts of mutual funds. 12.2% are invested into individual stocks, and there's an exposure to one particular ETF, which carries a weight of 1.4%. Then on top of that, and there's a lot to uncover or unveil here, he has a 2% cash position. He is also 5 years into a 25-year mortgage. So I guess this is, no, it's not the home he's living in, because he said he pays rent, right? So I'm not entirely sure which home this is.
Must be the one he rents out that he has a client resident living.
Yeah, but then the rent he receives on that home shouldn't cover his own rent expenses, right? So
depends on the pricing, I guess.
Yeah, we don't know. But then on top of that, and I found that quite interesting, I would consider this sort of an alternative asset. He also owns a parking lot, which gives him around a 6.5% yield. And that parking lot is apparently worth 25,000 euros. So that's quite interesting too.
That one's pretty neat. Yeah.
As I said, there's a lot to uncover here, but the first thing you have to notice and that we have to address here is the large exposure to Spanish 1-year bonds, which actually yield 3.5%.
Yeah, that
So-
one, my question on that, and once again, I'm obviously biased. You know, you're from Germany, I'm from the United States. I'm extremely biased to the strength of the United States and everything. But it's not so. Number one, I don't know about Spanish fixed income. I don't know the rating of that or anything like that. But at a 3.5% yield, I guess my main question, especially for a 1-year lock, why would you have not just bought short-term U.S. government bonds yielding well over 5%? This past year, that'd be my main question. Especially if you just wanted something in a fixed income, you could have got an extra 2 percentage points out of that. But that's just the first thing that I immediately thought of.
Yeah, and I agree. I don't know why you would choose Spanish bonds over US bonds here.
Yeah,
I guess,
and like I said, if it's yielding
to...
3 or 4% more or something like that, then yeah, maybe the risk is worth it or whatever. But yeah,
I guess it's probably due to some kind of home country bias. Maybe it feels a little safer to invest in your own country's bonds, but objectively speaking, or assessing it objectively, I agree with you, especially when the yield is lower and the US bonds are safer probably too. So, but as it stands out that he has such a large exposure, and I mean, he's quite young. He wants to invest for, I think he said 30 years. Why is he investing in relatively low yielding 1-year bonds? And so I asked him again, because I didn't want us to criticize him here without knowing his actual backgrounds. And I shared the message with you that he sent me beforehand as well, right? So apparently he was running his own bar for a couple of years. Then he cashed out. He sold the business to his business partners for 90,000 euros. Apparently has a tax payment due next year of 20,000 euros. So it makes sense to me that he wanted to invest that money sort of in some sort of short-term instrument that at least protects the purchasing power of that money, right? So all of that makes sense. But then it's only 20,000 of the 90,000, which would leave you another 70,000 to invest. If we look at the overall portfolio size again, 70,000 of the total portfolio size is pretty much 50%, a little more actually. And he said, well, he simply doesn't know yet what he wants to do with the 70,000 once, the bond matures. And I think he has to gain clarity with regard to this question, because in investing, you always have to think about opportunity cost. And if 50% of your investment net worth is sitting in an instrument that is yielding 3.5%, actually checked, and obviously there's a lot of hindsight bias in here as well, but the S&P returned around 18% this year. So there's definitely like significant opportunity costs you have to take into account here. And to me, if we look at the message he sent me, it seems like he hasn't gained any clarity on what to do with these 70,000 by now. And I think that is something he needs to start thinking about.
Yep.
Yeah, so I don't know. That is something I would feel incredibly uncomfortable with, having the majority of my net worth sitting in Spanish 1-year bonds that are yielding quite a low return.
Yeah, it might just be, I mean, he has the taxes to pay, and maybe he knows he wants to invest in the stock market, but just wants to keep learning more. And maybe he wanted to take that year, hey, I'm going to park this in, Spanish fixed income, learn more about investing, and then when I do get this money, then I'll feel more comfortable investing it. Yeah, maybe that's it.
Yeah, I can get behind that rationale. That makes a lot of sense to me now that you phrase it this way, because obviously, if you start investing more significant sums of money without knowing what you're doing, this can be quite a costly.
It compounds, and
you have to pay too, right? So
yeah, it compounds, and it can compound to the negative, so to the downside.
Yeah. So if your ultimate goal is to invest actively into individual stocks, I can get behind that. So that actually makes a lot of sense to me if you phrase it this way. Then the other thing that stands out to me is all the different funds he owns in the mutual funds bucket, so to speak. So that part of his portfolio represents or is worth around 24,000 euros, which is also not insignificant. And obviously the largest one here, that's just the S&P. That's, I guess, sort of don't want to say no-brainer, but that is sort of something you see a lot when you talk about index funds. But then I looked up two of the other larger funds within this bucket, and I looked at the fees. And for example, this one here, the Cylon World Growth Fund, it charges an ongoing fee of 1.6%, which is absurdly high. It's really hard to compound your wealth if 1.6% every year goes to the fund issuer. And then on top of that, there's also an initial charge of 5%. And that is something that I feel like more and more people in our generation, so I guess among younger people, have become aware of, that fees kill the compounding process.
Yeah, I think it's also become...
If I were him, I would get rid of these funds, because the other one is also charging quite a hefty fee, 0.95%. I would probably just get rid of them immediately.
If he's doing passive investing, or a portion of his portfolio into passive investing, which there's nothing wrong with. In my brokerage account, I don't have any passive investing, but that's because I have a 401k, which is through my employer, which is passively invested. So I have nothing against a portion of your wealth being passively invested. Buffett's recommended it, right? Most people understand the effects of it, especially buying, whether it be the S&P 500, or you could buy a global world index, which is mostly S&P 500, but it gives you protection to if China's the next world order, or Japan, or whatever it may be, right? Mutual funds, though, I just don't understand, because most of what mutual funds do anyway are investing your money in the S&P 500 and then just a mix of bonds based on when the whatever that allocation requirement is, and then so not only are you underperforming the S&P 500 on most years because you have a portion of that invested in fixed income, but then you're also paying fees on top of it. So mutual funds, to me, by and large, just don't make any sense nowadays whatsoever, especially with all the low cost indexes, the ways of acquiring a low cost index nowadays, which did not exist, maybe 30 or 40 years ago.
Yeah, 100%. And the data on it is pretty clear too, right? So I think for a video quite recently, I looked up some more recent numbers again, and over a 10-year time period, I think 91% of all actively managed mutual funds underperformed their respective benchmark, which is pretty sobering, I guess, right?
Yeah, which that first one you just showed us is 6.5% essentially off the top.
Yeah.
Imagine if even some of the best investors of all time, if you put a 6.5% drag on their portfolio, they're not beating the S&P 500.
Yeah.
And that's some of the best, right? So, I mean, and like I said, mutual funds are really just probably investing in the S&P 500 plus a mix of bonds too. So no, definitely I would scrap those. I can't understand why you'd want those in your portfolio at all.
Yeah, I agree. What's your take on the parking lot? I mean, the 25,000 euros is not included in the overall portfolio value. So percentage-wise, how much would that be? Something like 15% maybe. You say cool? Yeah.
Yeah, I mean, to own property and it just prints you 6.5% all the time. And then of course it's property. You could sell that down the line. And I can't imagine there's much upkeep to it, right? Maybe you have to pay someone to retop the parking lot, parking garage, or whatever. Especially if it's just a straight parking lot that's not a building. I don't know what the specifications are to it, but yeah, I'd love to be able to buy one of those over here. Just anytime property goes on sale around here, it gets developed upon. Yeah, no, that's cool. I think that's a really, really nice asset to have, and I would not recommend selling that if there's no need to.
I'm really not sure what to think of it, quite frankly, because again, I would approach it from an opportunity cost point of view. So as you rightly pointed out, I guess the asset itself may also be appreciating in value. So you have to take that into the total return estimate as well. But then again, if you say your benchmark is the S&P, for example, and let's say, and we don't know, right? But let's say the S&P continues to compound at a rate of 9%, and that's a compounded return. And the yield here, that's not a compounding return. It's just basically a cash flow you get every year, and then you have to decide what to do with it. I would assume that the S&P is probably going to give you better returns over a longer time horizon. So
It probably would, but I, I mean, pure cash flow like that. I mean,
Mhm.
so sometimes it's worth it. Yeah, you're giving up some. I mean, you take that cash flow and put it in the S&P 500. We could also take that cash flow and buy, another real estate property with it. Maybe another parking garage. You can take that cash flow and put it towards, vacation, your daughter's college fund, whatever it may be. I mean, to have an asset that kicks you off cash flow, is extremely valuable. Even if, sure, that cash flow isn't earning you maybe 20% a year or something like that. Still a 6.5% cash flow. It's better than just cash sitting in his 3.25% Spanish fixed income. That's for sure. So
yeah, I would say it definitely makes for a good story when you tell people at a party, well, I own this parking lot too, and it yields, I don't know what is like 1,000. I mean, if you translate it into monthly cash flow, that it's not that significant actually. What is it? Maybe 150 euros a month. Your comment just reminded me of what you said last week, where you described that you started out with a focus on dividend paying stocks, and that the cash flow you received from those dividend paying stocks made you approach the stock market with a longer term mindset. So I guess that's because what I can hear within your comments.
Yeah. Here it's real cash coming in. So, I mean, it really does. It helps. I mean, yeah, of course, investing in purely numbers. I mean, you could run a compounded annual growth rate calculator at 20% per year. Yeah, you'll be the world's richest man in 30 years. But I mean, real cash flow coming in, that's hard to argue with, especially at 6.5% yield. Also, I don't know if that was pure cash he paid, or if he financed that at all with perhaps a lower interest rate than a 6.5%, because then at that point his return on equity might be even higher than the 6.5%. It could be, if he's 2 times levered on it or whatever, it could be a 12% yield or something. So, I don't know.
It's definitely something interesting, and we probably won't see all too often in the portfolios we will look at. So I appreciate that he shared this asset within his portfolio as well. So we'll now move on to basically the stock portfolio within his broader investment portfolio. I know, Andrew, you don't care about it very much, but just for the viewers, I think some might find it interesting. Let me share the geographical exposure of his stock portfolio. So clearly, Spain plays a role here as well, which again might make sense if you consider that he's from Spain himself. And I guess many of the Spanish companies are more in his circle of competence than companies that are maybe not operating globally, but just in the nation they are domiciled in.
Nothing wrong with that either. Monish Prabrai with India, Lilu with China. I mean, having an edge in those markets, if that's where you're from, makes complete sense to go fishing in those ponds, especially with how over-concentrated and over-competitive the U.S. market is.
Yeah. Here we see, give me 1 second, his sector exposure. I'm just going to show it on screen for the viewer, and we'll jump pretty much straight to the individual stocks in just a second. His industry exposure, I don't have any material comments to make here myself as well. So here we can see his stock portfolio, which is worth $16,000 right now. On the right, I noted down that his top 5 positions represent 68% of the entire stock portfolio, which is definitely a high level of concentration. But what I would say here is, as the $16,000 don't represent a meaningful amount of money to him relative to the contributions he's able to make on a monthly basis. So that's around 1 year of contributing to your investing portfolio, right? Early on, and I think you said something similar last week, the level of concentration isn't as relevant if you are early in your investing journey. In fact, in your first year of investing, I think it's completely fine to invest only in 1 or 2 stocks, just because your portfolio will become more diversified over time anyway, as you keep contributing and likely add new stocks to that portfolio.
Yeah, so I thought the same thing. When you sent this over to me, first my eyes just went straight to the holdings, and I said, "Wow, 10 holdings, extremely concentrated in the first 5 or 6, with mostly extremely high quality names that I'm familiar with." I thought that was a great portfolio. And then same thing, I realized his total net worth and the value of the portfolio, and then I said, "Oh, he's probably far too diversified in my opinion currently. And I agree. 16,000. I mean, I'd probably have 2, maybe 3 companies at the most right now. In that, maybe call them $5,000 bets. I'd probably argue maybe a $10,000 and then $6,000 bet, whatever. Yeah, that's. But like I said, if his entire net worth currently was in his stock portfolio, then yeah, that's a nicely quote unquote diversified portfolio. But yeah, currently with the total value, I just think it's probably once again too diversified at the moment because he's still learning. So
yeah. So in future videos, and I think the guys at Koifin are working on that, I want to actually focus a little more also on the investing performance. So what are his gains and his losses, or the person's gains and losses on individual positions. But as Lorenzo has only been investing for a couple of months, I think there's really no point in assessing his performance anyway, because it's such a short term. And I think assessing investing performance only becomes relevant once you have been investing for at least 2 years, ideally even longer. I think Geoff Gannon from the Focus Compounding podcast once said that to truly assess whether you add value by picking stocks, you have to take a look at 10 years or more.
I would agree.
Stocks,
yeah. You can't even do 5 years. I mean, look at Kathy Wood. She had a phenomenal 5-year track record at one point, and now she has one of the worst. So, that's also something else to add too, which I completely spaced on, was how soon he has purchased all of these companies into his portfolio. Is that you're telling me over the past just several months of starting out, you found 10 wonderful investment opportunities right off the bat, and they're all relatively equally as good. I mean, you really shouldn't be adding to, I don't know, what's his bottom portfolio holding there? UiPath. You probably shouldn't add to that if you like Visa, way better or whatever. I don't know. I just, once again, it's probably a valuation opportunity cost mindset that he just hasn't probably gotten comfortable with yet. That's my guess.
Yeah. I was recently bringing up the Warren Buffett punch card analogy in my mentorship program. I truly believe that if you would artificially limit the number of bets you can make per year or per decade to, like, the punch card analogy is like 20 per lifetime, right? You would do tremendously better because you would be much stricter in terms of which companies make it into your portfolio, and I guess most importantly, at what price.
Well, you're constantly thinking of, it's forcing you. The punch card analogy is really just constantly making you think about opportunity cost. That's really what it's constantly making you think, and it's making you think, is something that I don't own, and something that I don't own and that I don't know, is it worth more? Am I that positive that's worth more than something that I do own and that I do know very well? And that's the punch card analogy. It's really an opportunity cost mindset.
Yeah, and we sometimes struggle with it too, right? I remember you recently told me, actually, I set the goal for me. I think, I'm not sure if it was this year or if you started with it last year, to stop buying stocks trading above 15 times earnings, I think it was. And then I don't remember which stock it was, but you were kind of critical about your own, like, decision making.
Yeah, it was forward earnings, and that's just something from my past experience. 9 out of 10 wonderful companies that I've looked at to invest in through my, I don't know, 8 years or whatever investing. 9 out of 10 at some point have gotten down to a valuation that made sense. Just it's that patience. I have pretty bad patience. So that was a arbitrary number I set myself just to really teach myself about, just to really train myself on patience. And actually, so far, it's actually worked out extremely well for me. So, just patience and opportunity cost is very important.
Yeah. If we look at this table here, so we are now getting to basically the quality side of things here, what we think of the quality of the different holdings. Here we see an overview of the different companies with regard to various metrics. So we have valuation metrics, profitability metrics, debt and growth metrics. And I always like to start by taking a look at the weighted average here. I know last time you pointed out that, of course, this this line basically becomes less relevant if there's a significant outlier. But I don't think we really have one here. And if we just look at the valuation of the entire portfolio on a weighted basis, for example, it looks fairly priced, I guess, at 21 times earnings. What stood out to me is that on a forward earnings basis, it is actually more expensive, which kind of, obviously this is based on analyst estimates for future growth, but it shows that apparently this basket of stocks will not grow materially over the next year. If that makes any sense.
Yeah, I noticed where it was coming from though. And my question, and I wonder if viewers might have the same question, is those ones that are currently not profitable, so SoFi and UiPath, does that count as a zero or does that negate it in the calculation? If it counts as a zero, then obviously that's going to skew it. But if it negates it and then negates the forward price to earnings as well, then you're using normalized comps, and I have no complaints about that. But yeah, obviously his second and third holding was at Puig brands and then Nike. Both currently have higher price to earnings, and both make sense. Puig is the perfume, hair care, beauty brand, I guess it is. And then Nike, of course, in the apparel, and both of those categories are kind of struggling at the moment, so I guess it makes sense. Will analyst estimates be right or wrong? I have no idea, but yeah, it makes sense.
Yeah, those are very good points actually. I would just stress that's the next year of earnings growth, right? So we like to think longer term than just 1 year out, and I think the companies you mentioned here, so Puig brands and Nike, for example, they will do well long term. I have very little doubt regarding that. Then again, on a look-through basis, if we look at the profitability, for example, I think, and that's mainly due to Visa representing more than 20% of the overall portfolio, this looks really, really good to me. So we have a gross profit margin, like a weighted average of 66%, the EBIT margin of an EBIT margin of 30%. There's quite a significant gap between the operating income margin and the free cash flow margin adjusted for stock-based compensation. And as you pointed out, that's likely due to SoFi and UiPath, just because these businesses, at least SoFi, I think, is not profitable on a free cash flow basis, but is on an operating income basis. But the point I just wanted to make here is that on a look-through basis, overall, this looks like an above-average basket of stocks.
Yeah, and I mean, honestly, his top weighted ones. I mean, I don't know Puig too well. I briefly looked at it. I understand the category, and those, by the way, family-owned, over 100-year-old brands, high-quality brands like that can actually make, especially if they do just constant share buybacks or whatever it may be. Those have been some of the best performing companies. So I don't doubt that it could be. I don't know much about it, so I can't really give you much input. But
were you aware of that company beforehand?
No, I was not. No, I just did a brief look at it. But I understood it real quickly once I looked at it.
On my watch list today, because I think this is actually a very interesting company. Yeah. What I've read is that it IPO'd only this year, so in 2024, and apparently was also the biggest IPO of this year, which I found quite interesting. Yeah. I did not read that it's family owned, is it?
Yes, it is family owned. That's the brief research I did showed that it was family owned still.
That makes it all the more interesting to me. And before I tell you why I think this is an interesting company, let me just read out the company description, or at least the beginning of it. So I guess most viewers will not be familiar with that name either. So they have kind of an idea what that company is actually doing. So on ticker, it says, Puig Brands operates in the beauty and fashion industry in Europe, and so on and so forth. The company designs, develops, and markets sprays and colognes, lotions, powders, creams, candles, and soaps, and clothing, footwear, and accessories and then all of the brands that they basically own are listed here. And what I've read is that I guess L'Oreal would be a good company to compare it to, but apparently I think they are more focused on the cosmetics and fragrance verticals. Yeah. But I think L'Oreal is still quite a good benchmark. I looked at the gross margins of Puig brands, which is really high. I was actually surprised by that. It's above 70%. And that margin profile is very similar to L'Oreal, which clearly is also an above average business.
Yeah.
So I found this an interesting one. What I should say is I don't know much about the cosmetics industry. So if I were to read the brand names to you, I'm just assuming, Andrew, that you would probably not be familiar with most of the brands too. If, on the other hand, I would ask my wife, I actually read the business description of L'Oreal to her the other day. She knew probably 70% of the 30 different names I was reading to her. But I would have a hard time assessing the strength of the brands. And I can only tell by the numbers. So 70% gross margins. This shows you that we are really in the luxury cosmetics.
Which is experiencing definitely a downturn right now, which I mean explains the forward earnings being less than the trailing earnings. But if you were to take a longer term time horizon on this, this one could work out. I mean, I don't know. I didn't look at valuation at all or anything like that. My question would be, though, if it's family owned, why did they IPO after over 100 years now? What do they need that capital for? Or is the family looking to exit? Are they looking for an exit and they're looking for liquidity? I don't know. These are, once again, answers that questions I'm currently thinking of, and it would be his job to find out those answers, right? If he's a shareholder. So those would be things that I would currently be thinking about. Overall, the actual profile of it sounds interesting.
Just to wrap up this name. So if we look at the revenue growth over the last 5 years, this one looks also very decent. Obviously, there was a drop during the pandemic, but if we exclude that, and again, look at I don't have the compounded growth rate here over the 5 years, but it's definitely decent.
Yeah.
And it's also not trading at an excessively high multiple. I think it's trading around at a low 20s EBIT multiple, which for a company of this quality is it's not overly pricey. Let me put it this way.
Yeah. Read the prospectus documents for when they were filing to go public. They have to put the reasoning for going public in there. I would say to read through those proxy statements and see what their reasoning for going public is, and to see if the family is maybe just selling shares. If so, that could also create a great buying opportunity too. But those are just questions I would want the answers to before investing.
Yeah. Then let's just very briefly talk about Visa, the largest stock in this portfolio. I took a couple of notes here, and I think most are familiar with the Visa, and I think everyone knows that Visa is in above average quality, right? So it's definitely a beautiful business. It's asset light. They basically have an inflation hedge embedded into their business because, well, it's a payment network, and network effects are in play here. For the company to grow, the company actually doesn't need to reinvest significant sums of money because they have most of the infrastructure in place already. And I guess the only point of criticism I could find with regard to Visa would be that this company is almost producing too much cash. So let's look at the numbers again. Let me scroll up here. I think they have free cash flow margins of 50%, which is absolutely mind-blowing. Where is it? Yeah, 51%, EBIT margins of 66%. And a company of this size with these profit margins has a hard time redeploying that cash or those profits internally, which will, of course, affect growth, but that doesn't mean you will have bad returns by any means. That's just one thing, one weakness, I guess, that comes with being such a good company.
Yeah. Something like a Visa, I would, once again, I mean, great company, priced like a great company, historically has outperformed.
I to say this,
it will continue.
We acknowledge it's a great company, but we don't own it. So I actually owned it for a brief period of time after the pandemic. But I'm not sure if I would be comfortable buying it here. But at the same time, it's not super expensive either. So
I can understand the thesis.
I'm comfortable with it.
Yep.
All right, Andrew, do you want to pick one of the other companies? We won't go through all of them, but I brought up, actually read one write-up on the company myself today. So if you want to, or feel free to pick one.
Yeah, we could. I mean, really Meta, Google, Nike. I know those three pretty well. The rest of the portfolio, I'm not too well versed in. SoFi, though, I do know relatively well. you have a slide there. I had not seen that. So
yeah, I'm not going to share it. It's just some notes I noted.
Oh, okay. Yeah. So SoFi being a Chamath SPAC obviously would turn me away from it a bit. However, it could also be a scenario where you're throwing out the baby with the bathwater, right? So one thing I know about SoFi, and I'm not a professional, and it would be my issue with SoFi would be trying to deeply understanding the risk profile and deeply understanding all the accounting because they're trying to be an all-in-one finance platform, which by the way, I actually have SoFi. I use the SoFi app. My issue as an investor, which would be, like I said, understanding the risk profile and then understanding like the accounting and everything like that, on that can be a bit difficult. That can be a lot to dig into. But then on top of that, I guess on a qualitative point of view, my issue with SoFi, yeah, they're gaining a lot of customers extremely quickly. They're growing like a weed, very similar to Robinhood. But my correlation between Robinhood, SoFi is that of like Robinhood to interactive brokers, which would be, I'm curious that once you hit a certain level with your finances, they're going after pretty much the bottom cohort of people, lower income, younger generation. Do you graduate out of that class and you go to something like JP Morgan, right? That's a question that I don't know the answer to. Similar to Robinhood, you see people, they have far more users than interactive broker, but the actual value of that user is far more valuable at something like an interactive broker versus Robinhood. So I guess that's kind of my main concern with SoFi. And then also a lot of their business segments are government affected. So they had an issue. What you wrote right there, 50% of their revenue stems from loans. And I think 10% or just shy of 10% of their total revenue comes from student loans.
I was about to bring that up because I didn't make that connection to them being like a lower income cohort, like being one of their target groups, right? So that's actually a very good point you bring up there.
Well, when the government said that they're going to be forgiving all student loans, that's actually really what helped bring the stock price down quite immensely. But those are issues I have. Is I don't know, if someone like Trump gets in office, he's not going to be forgiving student loans. But if someone like Kamala Harris gets in, I don't like investing in companies where their long-term prospects can really be changed by depending on what political party is in office or something. That those are just things that I'm not comfortable with, and that's why I haven't really dug too much deeper into this company. But those are my comments on it. Galileo, by the way, they own Galileo, which is kind of like the back end provider, similar to Braintree for PayPal. And that's actually very interesting too. But I believe that's only about 10% of their business currently. So.
Yeah, I looked up the numbers here. The technology platform segment is 18% of their revenue. I found this part of the business also the most interesting one.
Okay.
Like I barely understood it. So my takeaway was it's the AWS of banking. And I was kind of imagining you probably have different modules that other banks can pay for, so they can integrate it into their solutions.
Yeah, it's a payment processor. That's virtually it. It's really not much different than Braintree, Shopify Pay, stuff like that. My
takeaway from just reading two write-ups was it is a legitimate business. So I was a bit unsure of what to think of it because before today, I never looked into this business. I was just aware that I see it in my Twitter feed quite a lot. And whenever I see a stock a lot in my Twitter feed, that is something that, I don't know, creates some skepticism. So makes me think it's like another stock, for example, Palantir, that pops up in my feed all the time.
Yeah.
I'm not sure what to think of it, but apparently it is a legitimate business. However, and again, I looked up some numbers. Dilution would be something that would be sort of a red flag for me as of today, because since IPOing, their total share count is up 32%. And it's really hard to have good returns if a company is diluting shareholders rather excessively, because I think growth was very good ever since going public, but the stock is pretty much flat, and that is partly due to stock dilution. So that is something to be aware of. And just to get back to Lorenzo and Lorenzo's situation here, and that is also something I noted down. As someone who's relatively new to investing, there's no way
this one
he truly understands what this company is doing, because I myself, like pure financial companies, banks, and so far as I understand, is basically a bank that's at least 50% of the revenue comes from loans, right? The way their accounting works is so different. I don't understand it. I think their accounting books specifically focused on banks, and that is something you would have to really focus on to become well versed in analyzing banks, right? So I just doubt he truly understands what he owns here, and I would encourage him to have a higher hurdle in terms of which companies to add to his portfolio regarding how much he understands about the businesses. But don't.
No, I would say that I agree. Yeah, I would say this with a company like SoFi, and a lot of other businesses out there too. I mean, he owns UiPath as well too. But there's a lot of businesses, and I think this is important for just investors to take away, whether you're new to the market, not new to the market, whatever. It's something I've come to terms with a long time ago, though, is that there are plenty of businesses where you can make a bullish case for. I mean, there's so many out there. And SoFi, just because I don't invest in a business does not mean that I don't understand the bullish scenario. Oh, I understand it. I understand SoFi. I'm a customer of SoFi. I understand the use case to the app, why it's so much better than something like a Bank of America, right? I understand, the thesis to an all-in-one platform. Like I understand this. I think the issue a lot of investors don't do is they don't fully grasp the risks, right? So they're grasping the bullish thesis and what could go right for the company. I don't think that they're properly analyzing what could go wrong for the business, and maybe I think they get shiny object syndrome, maybe, or whatever it may be, where they go, yeah, those risks exist, but I doubt it will happen. Well, what if it does happen? Are you able to maneuver at that point? Do you know the business deep enough, right? Do you know the accounting methods deep enough? Do you understand the risk of what happens if someone's account balance gets so high and then they transfer to something like a Goldman Sachs or JP Morgan or whatever? Like, have you thoroughly analyzed those risks? And my hunch is that most haven't. But once again, I understand why it could work out, and I'm not saying it won't work out. I'm just saying the reason, I myself and, Renee, even if he were to dig deeper into it, wouldn't invest, would be because those risks probably outweigh the benefits at that point.
Yeah, perfect. I have one last comment on the individual stocks we're looking at here. So I looked at the two other Spanish holdings in this company, and those would be Repsol, which is sort of an energy company. And I think we've made our take on energy companies as a group clear in the last video. So you really better understand which part of the cycle they're in, because on average, those tend to be below average businesses. I looked at the return on capital numbers of that business, and they were not great.
Yeah. And the reason he likes the oil one, I can guarantee you, is the 7.5% dividend yield. But look at the stock price, it doesn't go anywhere. And most utility companies do trade like a bond. I mean, so that shouldn't be anything surprising.
Yeah, good point. And the other one is Aedas, which apparently is a home builder. Yeah. The only comment I wanted to make here is that I would say, as a group, home builders are probably also at best average businesses. I think the one company you have to bring up here is NVR, because they have a slightly different business model. I think they don't own the land, right? So they only have option kind of contracts on the land, which creates this dynamic that they don't have to make a cash upfront payment before they actually have someone building a home. So I guess that would be something I would dig into. I would really like to see, because I think more home builders are now adopting the NVR playbook. And if this one here is not adopting it, I would probably stay away from it. Like, I haven't looked at valuation here, but just broadly speaking in terms of the business.
Yeah, I would also think, to use an analogy, levels to a video game or something like that. If he's only investing for a few months or whatever, the accounting, the way that they realize revenue can be very different between home builder to home builder. Understanding, well, he lives in Spain, so he might have a better grasp on the Spanish housing cycle. But I don't. But there's a lot to home builders, deeper than just revenue and earnings. There is a lot more nuance to it, and I doubt someone who just started out investing probably fully understands the accounting and everything there. Once again, that's even something I struggle with, and I've been doing this for like 8 years. So yeah, I caution on that as well.
Yeah. If I were to draw a conclusion here, I would say I feel like he's lacking clarity in terms of his investment approach. It's sort of all over the place. We have like 70% or 68% exposure to a 1-year Spanish bond. We have real estate. We have the parking lot. And then we have a bunch of different stocks from a bunch of different industries. And I feel like it's sort of all over the place. If we look at the stock portfolio itself, I would argue that this basket is probably of above average quality, so I like that. However, as you pointed out, you would also have to take into account the purchase price, and he was probably not demanding enough if he already owns 10 different names after just half a year of investing. So that would be my conclusion. What's your conclusion, Andrew?
Yeah, so I don't mind, like I said, the parking lot, owning a house that you rent out. I mean, I think those are all great streams of cash flow. I don't think there's anything wrong with that. However, if you do want to take investing seriously, and the stock market investing, picking individual stocks, it requires a lot of focus. It requires a lot of work. It almost requires, I'm trying to think of the word for it, but the mindset you need is almost peculiar, in a sense that you have to be kind of obsessed with numbers and reading very dry material that not many people are. And so if that is something you're into, then just realize, though, I mean, it is a lot of work. Right off the bat, though, I would say those mutual funds, if it were me, once again, never financial advice, though, those mutual funds, you're just pissing money into the wind. I would say you're probably better off moving that into index fund if you want to passively invest. And then, yeah, stock picking, narrow it down. Once again, you do own some very high quality names, Meta, Google, Visa, Nike, right? Those are all great companies. Have you done the valuation work properly? Have you really dug deep enough into it? So those are things, right? Have you properly analyzed the risks? I think maybe just go back to the drawing board, see what you really want to do. If you want to take stock picking seriously, maybe drop down to 2 or 3 businesses, weigh out the ones in your portfolio that you think are probably the best bang for your buck right now, and understand why, and track those over a year or so. And then hopefully that time when that big cash sum that are in your Spanish fixed bonds right now, when you end up getting that money, hopefully by that point you're ready to maybe invest in another company and slowly maybe roll that money into the capital markets. So.
Yeah, that's great. Again, we are asking for your feedback. How did you like the second episode? Let me just check the time. I think there's no way we kept it under 1 hour. I think
probably not.
Probably like I don't know when exactly we started. I think
close. We started it's probably about 1 hour, maybe just over an hour. So
I think the episode is going to be longer than the first one. So let's wrap it up here. We appreciate your feedback, and we'll be back in 2 weeks. I think, Andrew, right?
Yep.
Okay. Bye. See ya.